if you look at the Direxion Daily TSLA Bull 2X ETF ticker, TSLL, you basically see this massive collision happening right in front of you.
Oh, absolutely. It's a mess.
Right. I mean, on one side, you have this violent short-term rally just yanking the price upward. But then on the other side, you've got this brutal, overarching falling trend. And it's paired with these massive institutional sell signals.
Yeah, the divergence is just, well, it's severe.
It really is. So the core question for anyone looking at this asset today, which is April 14th, 2026, by the way, is whether this is some heavily undervalued buy opportunity or if it's quite literally the ultimate value trap just waiting to crush retail traders.
I mean, that is the defining debate in the options and leverage space right now. And the hard part is, both narratives actually have hard data backing them up.
Yeah.
It really just depends entirely on what your trading time horizon is.
Which is exactly why we need to pull the engine apart today. We are doing a complete deep dive into the financials, their highly contested technicals, and the underlying narratives of TSLL to figure out what is actually driving this price action.
It's going to be a fun one.
For sure. But before we jump in, you know the drill. Make sure to hit that like button, subscribe to the YouTube channel, and I'm making it compulsory for you to leave your comments and feedback down below. We really want to know what you think about this.
We read all of them, so definitely drop a comment.
Exactly. So getting into it, when I look at TSLL, I don't see a regular stock. This is a highly specialized financial power tool, right? It's built to deliver 200% of the daily performance of Tesla.
Right. Daily being the key word there.
Yeah, and regular Tesla is already moving like some hyper-volatile tech startup. So my question is, isn't strapping a 2x multiplier to it, basically like driving a sports car with the accelerator just totally stuck to the floor?
Well, I'd probably frame it a bit differently. I mean, it doesn't incinerate capital by accident. It does it by design, if you use it incorrectly.
How so?
You really have to understand that leverage alters the basic physics of the investment. A 2x ETF does not promise double the return over a year or even a week. It promises double the return for a single day.
Just one day.
Just one day. So when you amplify that daily exposure, you aren't just amplifying the upside. You are massively magnifying the daily structural chop. If an investor treats this like a conventional buy and hold stock, I mean, they're using a scalpel to chop down a tree.
Wow, okay. That makes looking at the current financial snapshot critical because people clearly are treating this thing like a massive sandbox.
Oh, yeah. The inflows are huge.
Right. As of the last close, TSLL is quoting at $11.54, which is up 6.75% for the day. But the 52-week range is what really catches your eye.
It's a wide swing.
Huge. It swung from a low of $6.49 all the way up to $23.74. You see that high, you see the current price, and I mean, the human brain just naturally screams, oh, it's half off.
Right, the discount illusion.
Exactly. And investors are backing that up with serious money. The fund has approximately $4.45 billion in net assets under management.
Which is just a staggering amount of capital for what's supposed to be a tactical short-term instrument.
Right.
It really tells us that a massive chunk of that $4.5 billion probably belongs to retail traders who might not fully grasp the decay mechanics, which we'll definitely get into later.
Yeah, we have to talk about that.
Because they see that $11.54 price tag and that 23.3 peak, and they just assume they're buying at a discount. But an ETF's price isn't inherently discounted just because it's down. The price is just a mathematical derivative of the underlying asset's daily movements.
And it obviously costs money to maintain that math, too. I mean, the expense ratio is sitting at 0.83% net and 0.95% gross.
Standard for this kind of leverage.
Sure, but the detail that really scrambles my radar is the dividend. TSLL currently has a variable but honestly massive dividend yield. It's somewhere between 7.98% and 10.35%.
Yeah, that catches a lot of people off guard.
I bet. The last payout was basically 10 cents a share back on March 30 fund. But paired with that yield is a beta of 3.88. So this ETF is nearly 4 times as volatile as the broader market.
Almost 4 times, yeah.
So with a beta approaching 4, how does a fund like this actually sustain a 10% dividend without just collapsing under its own weight? Aren't you basically just being bribed to hold on to a live grenade?
I mean, it sustains it precisely because of that weight, right? The dividend on a highly leveraged ETF like this is, well, it's rarely generated purely from traditional company profit.
So where does it come from?
It's often a byproduct of the complex derivatives, the swaps, and the lending mechanisms that the fund managers have to use just to maintain that 200% daily leverage.
Okay, that makes sense.
Yeah, when volatility is this extreme, like when you have a beta of 3.88, the premiums on those financial instruments just absolutely skyrocket. So the fund captures some of that elevated yield and passes it down to the shareholders.
So it's not really traditional passive income, it's essentially hazard pay.
Hazard pay is the absolute perfect way to describe it. The market is compensating you for taking on an enormous amount of structural risk.
Like if the S&P 500 sneezes, TSLL catches pneumonia.
Exactly. You are being paid that near 10% yield because the probability of the underlying asset swinging wildly against you is just exceptionally high.
Okay, so if the asset is paying out hazard pay, the next logical question we have to look at is who is actually taking on that hazard today?
Let's look at the charts.
Yeah, because the technical indicators show a literal war happening on the charts right now. The broader picture is this short-term recovery that is completely trapped inside a much larger bearish channel.
Right.
And the momentum signals are just wildly split. The 14-day RSI is up at 67.39, and the MACD is at 0.26, which recently turned positive.
So those numbers require a bit of nuance.
How so?
Well, an RSI pushing 67 is getting incredibly close to that 70 threshold where algorithms and technical traders typically start viewing an asset as overbought.
But it's not quite there yet.
No, not yet. It still shows raw upward buy momentum in the immediate term. And that positive MACD confirms that the short-term trend has, at least for the moment, flipped bullish.
But the moment we map those short-term momentum signals against the moving averages, the bullish story just hits a total brick wall.
A massive wall.
Yeah, the 5-day SMA is at $11.57, which is basically flat. The 50-day is down at $10.69, which is acting as your floor or your immediate support. But looming over the entire chart is the 200-day SMA up at $12.71. That line is acting as massive resistance.
Yep.
Why does a single moving average act as such an impenetrable ceiling for an asset with this much daily momentum?
Because the 200-day moving average isn't just some arbitrary line on a chart, right?
Right.
It is a serious psychological and algorithmic boundary for institutional capital.
So the big money is watching it.
Exactly. When an asset like TSLL approaches that long-term average from below, there are literally thousands of automated trading systems hard-coded to trigger sell orders. They view the approach to the 200-day not as a breakout, but as an opportunity to short the rejection. So it basically becomes a self-fulfilling prophecy.
And the data proves they are doing exactly that. I mean, we've seen short interest in TSLL spike by 22.39% recently.
That's a massive jump.
It is. There are currently 55.85 million shares sold short, which is 15.44% of the entire float. Institutional money isn't just passively waiting at that $12.71 line. They are spending millions to actively drag the price down.
Right, they're stepping on its neck.
Exactly. It's like a literal tug of war on a cliff edge. Short-term indicators are pulling it up, but short sellers are piling on 55 million shares of weight to drag it down. But here is the piece of the puzzle that just doesn't fit for me.
What's that?
The call-to-put ratio is at 0.5. Put interest is actually lower than call interest. If call volume is weaker than historical averages, are the bulls just running out of rope? And if institutions are betting so heavily against the ETF, why aren't they just loading up on puts?
Well, you have to separate the options market from the equity short-selling market here.
Okay.
A call-to-put ratio of 0.5 does indicate more call volume overall. But like you said, the data also specifies that this call volume is actually weaker than the historical averages.
What's the play?
What we are likely seeing is retail traders buying short-term calls, trying to ride that MACD momentum up to the resistance line.
While the big players do what?
While institutional smart money is directly shorting the shares themselves to absorb all that retail liquidity, the institutions aren't buying puts because puts suffer from implied volatility crush. Shorting the shares directly is just a cleaner, more efficient bet that the $12.71 wall is going to hold.
Okay, that dynamic really forces us to confront this whole value trap debate. If retail is buying calls and institutions are shorting the underlying shares, somebody is wildly wrong about the intrinsic value here.
Someone is going to lose a lot of money, yes.
Looking at the broader analyst consensus for regular Tesla stock, it is largely sitting at a hold. And the primary negative signal dragging that sentiment down is the lowered 2026 delivery outlook.
Right, the delivery numbers are key.
Yeah, they're projecting roughly 1.69 million vehicles. So how heavily does a macroeconomic number like global car deliveries really weigh on a purely synthetic leveraged day trading tool?
Oh, it weighs incredibly heavily because the ETF's premium valuation, I mean, you mentioned that 184 PE ratio earlier, that relies entirely on Tesla maintaining its status as a hypergrowth tech company.
Right.
The moment you lower delivery estimates to 1.69 million, you signal that the fundamental growth story might be stalling.
And if growth stalls?
If growth stalls, that premium compresses. And when the premium on the underlying asset compresses, the leveraged ETF tracking it doesn't just decline, the downside actually accelerates exponentially.
Which perfectly explains the split in the outlooks we are seeing in the sources. The short-term projection is cautiously bullish. I mean, it's gained for 4 consecutive days. And today's trading interval is projected to bounce between $11.06 and $12.02.
Yep, the momentum is there today.
But the medium and long-term outlook is strictly bearish. Analysts are citing a defined falling trend, warning of a potential 36% decline over the next 3 months if Tesla fails to break that major resistance.
36% is massive.
It's brutal. So I have to ask, if the fundamental math suggests a 36% drop is looming in the next 90 days, how can anyone argue it's undervalued? Doesn't that explicitly make it a trap for anyone who isn't just staring at a trading terminal all day?
Well, it absolutely makes it a trap for a long-term investor. And this is really where we have to fundamentally separate an asset's inherent value from its tactical trading utility.
Right. Value versus utility.
Exactly. For a day trader, that 4-day bullish streak and the positive MAFED, that is the value. They don't care about a 36% potential drop in 3 months because they plan to be entirely out of the trade by Friday.
That makes sense.
But for the retail investor looking at that $11.54 price and thinking they're buying Tesla at a multi-year discount, yes, it is a highly dangerous value trap, primarily because they just don't understand the invisible mechanic that's actively working against them.
Ah, you're talking about volatility decay.
Exactly. Volatility decay, or beta slippage, is honestly the silent killer of leveraged portfolios.
Break the actual mechanics of that down for the listener, because we hear the term decay thrown around, but how does an asset actively lose value if the underlying stock it tracks just moves sideways?
Let's just run the math, because it is the single most crucial concept for anyone holding this asset.
Let's do it.
Imagine Tesla stock starts at $100.
Yeah.
On day one, it drops 10% down to $90.
Okay. Simple enough.
Right. So for regular Tesla to get back up to $100, it needs an 11.1% gain the next day.
Right.
But TSLL is a 2x leveraged fund. If Tesla drops 10%, TSLL drops 20%. So its $100 goes down to $80.
Okay, I see where this is going.
Yeah. To get that $80 back to $100, you don't need an 11.1% gain. You need a 25% gain.
Wow. So the hole is dug twice as deep, but it's exponentially harder to climb out of.
Precisely. Because leveraged ETFs reset their exposure daily. If the underlying asset chops up and down, like up 5%, down 5%, up 5, down 5, the daily resetting of the leverage means the ETF mathematically bleeds capital.
Just from moving sideways.
Exactly. The underlying stock could end the year completely flat at $100, and the 2x ETF could be down 15 or 20% simply due to the friction of daily compounding.
You know, it's like trying to carry water in a leaky bucket while jogging.
That's a great analogy.
Like, even if you never intentionally pour a single drop out yourself, the constant shaking the volatility forces the water out of the leaks. By the time you finish the run, you inevitably have less water than you started with.
That is exactly what happens. The shaking is the 3.88 beta, and the leak is the daily resetting of the 2x leverage. When you combine high volatility with daily leverage, time is no longer your friend. Time becomes your active enemy.
That's a scary thought. So, knowing that structural leak exists and knowing there are 55 million shorted shares waiting at that $12.71 through resistance line, we have to look at the catalyst that could actually validate the bulls right now.
Right. What's the best case scenario?
Yeah, the best case recovery scenario driving this current 4-day rally seems to be fueled entirely by external narratives. The sources specifically highlight the Terafab and AI chip developments, alongside intense speculation around a SpaceX IPO.
The narrative trade.
But wait, SpaceX is a private, entirely separate company. Are buyers really letting hype from a completely different rocket company artificially inflate a leveraged automotive ETF?
You really have to factor in cross-asset sentiment and retail psychology here.
How so?
The market rarely behaves in perfectly rational silos. Tesla does not trade purely on its automotive fundamentals. It trades heavily on the Musk ecosystem halo effect.
Ah, the halo effect.
Right. When retail traders see advancements in AI chips, or they hear rumors of a massive liquidity event like a SpaceX IPO, they look for a liquid, publicly traded proxy to capitalize on all that momentum.
And TSLL becomes the absolute highest octane proxy available.
Correct. The excitement just spills over. Traders buy TSLA not because they think Tesla's going to sell more cars next week, but because they believe the broader narrative momentum surrounding Musk's ventures will force the algorithms to buy Tesla stock.
Pushing it right through that 200-day moving average.
Exactly. It really shows how narrative and emotion can temporarily hijack hard technical data.
But the bears are betting that gravity always wins in the end. The worst-case continuation scenario relies entirely on the underlying fundamentals reasserting themselves.
Right, they're looking at the numbers.
Yeah, the bears aren't looking at rockets. They are looking at the inescapable math of the volatility decay we just unpacked. They're looking at the lowered guidance of 1.69 million vehicles. And crucially, they are looking at insider selling at Tesla.
Insider selling is the ultimate counterweight to the halo effect.
How much does that really matter, though?
Oh, it matters. When the macroeconomic delivery targets are being revised downward, and the people inside the company who have the most visibility into the actual supply chain and margins are selling their shares, institutional bears feel incredibly validated in their short positions.
They smell blood in the water.
They do. They are betting millions that the AI and SpaceX narratives simply do not possess enough fundamental gravity to push the stock through a major historical resistance line, especially when the core automotive business is showing signs of contraction.
Which really brings this entire deep dive into focus. When you synthesize the financials, the technical tug-of-war in the opposing narratives, the Direxion Daily TSLA Bull 2X ETF reveals itself as an incredibly sharp, double-edged instrument.
Very sharp.
On the surface, it is offering day traders a tempting, short-term, cautiously bullish setup with momentum pulling it upward. But beneath that surface momentum is a dangerous, long-term bearish trend plagued by a potential 36% drop, compressing delivery forecasts, and a massive wall of institutional short sellers waiting to just reject the rally.
It perfectly illustrates why investors absolutely must align their financial instruments with their actual trading horizon.
Right.
Using a daily leveraged ETF for a multi-month investment thesis is just mathematically dangerous, regardless of how bullish you might be on the underlying company's long-term vision.
And I need to explicitly state for you listening out there that this analysis is strictly for educational and entertainment purposes. We are simply breaking down the historical data, the technical charts, and the prevailing market narratives as they exist today, April 14th, 2026.
Yes, no financial advice here.
Exactly. We are entirely impartial and absolute no financial advice is being given or implied.
But, analyzing this data does force a very uncomfortable question.
What's that?
We know volatility decay is a mathematical certainty in sideways markets. And we know institutional capital is actively shorting the resistance levels. So given the reality of volatility decay, if a leveraged ETF mathematically loses value in a flat, choppy market, are retail traders who try to buy and hold these instruments playing a game where the math is fundamentally rigged against them the longer they sit at the table.
Man, that is the exact reality check we have to leave you with. Because the thrill of driving a high-speed vehicle is undeniable, but if you ignore the structural leaks in the engine, the math is eventually going to catch up to you. Thank you for joining us on this deep dive. Keep questioning the data, keep examining the mechanics beneath the price tags, and we will see you next time.